The S&P 500 slid 0.37% on the closing print to finish at 7,473. The Nasdaq Composite took a violent hit, shedding 1.2%, which is a drop of nearly 300 points, down to 26,213.46. But then you look at the Dow, and it actually added 0.40% to close at 51,768.
Right. And the Russell 2000 surged 1.16%.
Yeah, exactly. The closing bell rang exactly 15 minutes ago for this Monday, June 22nd, 2026 session. And if you are only looking at the tech scoreboard for this deep dive, you are entirely missing the real story.
You really are. I mean, casually glancing at the NDX, you'd assume it was a total bloodbath today.
Oh, for sure. But we're looking at a fresh market rotation and institutional rebalancing strategy report here, and the underlying data shows a completely different narrative. So what was the actual driver today? Was this just chop, a head fake, or what?
This was a textbook aggressive rotation. It wasn't a head fake at all. It was the smart money systematically shifting capital. And to really see it, you have to look past those headline tech drops and look at the market breadth.
Right, the internals. Because on the surface, we had really thin post-Juneteenth summer drift volume. The S&P 500 volume hovered right around its 30-day average, roughly 1.05 billion shares.
Exactly. So we didn't get this high-conviction volume confirmation of a massive market-wide panic. Institutions weren't fleeing to cash. In fact, if you look at the breadth, the ratio was 1.8 to 1, favoring advancing stocks over declining ones.
Wait, really? Almost 2 to 1 advancing?
Yeah. Almost 2 stocks went up for every single one that went down. I mean, 7 out of the 11 S&P sectors actually closed in the green today.
That's wild. The main index prints red, but the vast majority of the actual companies are catching a bid.
Well, it makes sense when you look at the prior concentration. Before today, only 56% of S&P stocks were sitting above their 50-day moving averages. The indices were just completely top-heavy.
Completely artificially propped up by those mega caps.
Right. So today, the real money finally took profits from those overbought tech giants and funded value names, cyclicals, mid-caps, small caps. It's actually a really healthy consolidation.
It widens the foundation.
Exactly. It proves the bull market isn't just balancing on a tiny handful of AI hype stocks anymore.
But let me push back on that for a second. If the absolute biggest, most highly weighted tech companies in the world are stumbling, doesn't that inherently put the broader market at risk? Like, if we look at the tech hangover today, the star players took an absolute beating.
Well, they definitely did. I mean, look at SpaceX.
Yeah, SpaceX took a massive 13% plunge today, dropping down to around $165.
And that was a direct reaction to their historic $20 billion bond offering.
$20 billion is staggering. But why does taking on debt for AI CapEx cause the equity to instantly crater 13%?
Because of the massive interest expense. Building out these AI data centers, the satellite arrays, buying all those specialized chips, it requires intense hyperscaler capital expenditures. The institutional desks looked at that $20 billion debt load and said, wow, the interest payments alone are going to destroy shareholder bottom line flow.
So they're finally getting impatient. It's no longer just build the AI and we'll wait for the profits.
Exactly. The cost of capital is too high right now. And that fear wasn't isolated. Alphabet cratered 10% on the exact same fundamental fears about infrastructure costs.
Right, the contagion spread fast, but, this wasn't purely a fundamental tech flush, was it? We had massive plumbing issues under the hood today with the rebalance.
Oh, absolutely. Today was the official go-live date for the massive quarterly S&P 500 and NASDAQ 100 inclusions. We're talking about a projected $165 billion quarter-end systematic rebalancing wave.
$165 billion. That's a lot of paper moving around. And this is spearheaded by global players, right? Like Japan's GPIF and Norway's Sovereign Wealth Fund.
Right, the massive passive funds.
Yeah.
And they are legally obligated to track the index perfectly. So to minimize tracking error, these passive funds essentially forced all their buy orders through on the Friday close right before today's Monday go live.
So all the passive buying pressure was basically exhausted before the opening bell even rang this morning?
Exactly. And the active managers, the hedge funds who front-ran this event weeks ago, spent today ruthlessly selling the news.
Because there are no marginal buyers left.
You got it. Just look at Marvell Technology, ticker MRVL. They officially joined the S&P 500 today, but they closed down 3.90%.
Well, and it didn't help that their outgoing CFO was heavily dumping shares via insider selling.
No, that definitely accelerated it.
Yeah.
But we saw the same key reversals in the newly added NASDAQ 100 names too. CoreWeave dropped 9%, Rocket Lab fell 8.29%, and they are sitting on a $2.2 billion revenue backlog.
Wow. So the market completely ignored Rocket Lab's fundamentals because the mechanical sell the news pressure was just too heavy.
Exactly. It's a classic liquidity trap.
So if institutions are aggressively rotating out of tech and these newly listed AI names, all that capital has to land somewhere. And looking at the board, it flowed aggressively into financials and industrials.
It absolutely poured into value today.
I mean, Bank of America caught a huge bid into the close, up 2.21% to lock in an all-time record closing print of $57.44. And healthcare caught fire, too. AbbVie climbed 5.4% on that $10.9 billion buyout of Apogee Therapeutics.
And Apogee itself skyrocketed, what, almost 47%?
Yeah, 46.7%. So there's clearly a massive appetite for risk out there. But here is the craziest data point of the day for me. We have the NASDAQ plunging, mega caps dropping 10 to 13%, but the VIX barely ticked up.
Yeah, the VIX is the ultimate trap this week. It closed at 17.38, up just 3.58%.
Which historically looks incredibly calm. But it's a complete illusion, right?
Total illusion. It's a mathematical quirk of implied correlation. Right now, the one-year implied correlation among S&P stocks has collapsed to a near-record low of 10.
Wait, explain that for the listeners. How does a correlation of 10 mask all this volatility?
Well, the VIX measures the expected volatility of the index as a single entity. It doesn't look at individual stocks. So if you have tech violently pulling the index down, but financials and industrials violently pulling the index up, those aggressive swings just cancel each other out at the index level.
Oh, I see. Like a massive game of tug-of-war where both sides are pulling with incredible force, but the flag in the middle is barely moving.
Exactly. The VIX is only watching the flag. It completely misses that single stock volatility is absolutely raging underneath.
Raging is right. Look at Micron, ticker MU. They had a 5% rally today, but if you look at the options chain, they are pricing in a massive 12% expected move for their Wednesday earnings.
Market makers are terrified of that single stock risk right now.
Clearly. Now, the fact that money is flooding into banks like BofA isn't random. Banks profit from higher rates, which means we have to look at the bond market because fixed income is completely ignoring the energy sector right now.
Oh, the divergence between oil and yields today is probably the most critical macro signal on the board.
Yeah, so setting the baseline. We had geopolitical news out of Switzerland this morning. U.S. and Iranian negotiators agreed on a 60-day peace roadmap. And just looking at the pure mechanical market reaction to that, oil plunged.
It completely sucked the geopolitical risk premium out of the market.
Right. WTI crude slid below $75, printing at $73.86. Brent fell 2.6%. But normally, falling oil brings down inflation expectations, which brings down bond yields.
Usually, yes, it's an ironclad relationship.
But today, the 10-year Treasury yield actually rose to 4.50%, and the 2-year yield hit a 16-month high near 4.23%. How are yields surging when the main driver of inflation is tanking?
Because the bond market is completely consumed by the Warsh factor. They are ignoring oil and reacting strictly to the new Fed chair, Kevin Warsh.
Ah, right. His incredibly hawkish stance last week.
Exactly. I mean, he literally told the market inflation is a choice.
Which is basically Fed speak for, I am willing to cause serious economic pain to fix this.
Spot on. And even though they held rates steady at 3.50% to 3.75%, they aggressively raised their PCE inflation forecasts in the projections. The era of easy money is dead.
And the market is pricing that in fast. The CME FedWatch tool has an October hike priced at a 60.7% probability. Bank of America is even more aggressive. They're projecting 3 consecutive hikes starting in September.
Right, which all serves as the preamble for Thursday's crucial May PCE print. If that comes in hot, Warsh has all the ammo he needs.
And that loops us right back to the tech hangover. High rates aggressively discount the future earnings of those expensive tech megacaps, but they pad the net interest margins of the banks.
Exactly. It's a mechanical adjustment to the cost of capital.
Okay, so we've covered the split market, the VIX illusion, the $165 billion rebalance trap, and the hawkish Fed. Let's get actionable for tomorrow's open. What is the high conviction setup or key level we need to watch?
For the S&P 500, we slipped below 7,500 today. If the bulls can't reclaim 7,500 fast tomorrow morning, the immediate support is the 7,450 gamma wall.
And a gamma wall acts as a physical barrier because of market maker hedging, right?
Right. If 7,450 breaks, the delta hedging accelerates violently, market makers are forced into algorithmic short selling, and it's a fast trip down to 7,400.
Okay, what about the tech side? Where is the floor for the NASDAQ 100?
The critical soar is 30,200. We are resting right on it. If that breaks, the near-term bullish structure is totally voided, and we likely slide to 29,800. But if 30,200 holds, look for a day two play technical short covering rally back toward 30,500.
And I'd add, keep an eye on FedEx earnings tomorrow after the bell. That is the ultimate health check on global logistics right before the Thursday PCE data.
Absolutely.
So, synthesizing this for you, the sentiment is neutral but highly rotational. This is not the time to panic sell the indices. It's a time to look for value in cyclicals and secure yield while tech goes through a healthy correction.
Yeah. Trade the edges of the range.
Yeah.
But, it does raise one really uncomfortable question.
What's that?
Well, we just spent all this time talking about how the broader market, industrials, mid-caps, financials, is quietly catching massive flows and doing great. But the index scoreboards are being dragged down by the sheer weight of a few tech heavyweights.
Right. The index forces passive funds to keep buying the heavyweights even when they're exhausted.
Exactly. So what does this mean for the millions of everyday retail investors who just blindly dump their money into market cap weighted index funds? If index inclusion structurally marks the pop for growth stocks, are we entering an era where buying the whole market actually guarantees that you miss out on the real wealth generation?
That is a phenomenal point. Definitely something for you to mull over the next time you see the headline indices printing red and assume the sky is falling. That's our deep dive for today. We'll see you at tomorrow's close.